Well, the Nasdaq hit a one-month low yesterday. It's bouncing off of those levels as we get a little bit of a reprieve from the sell-off that we've seen in the bond market. But overnight, that U.S. 10-year yield hitting 4.5%, the highest level since 2007. Those high rates can act as a lid on tech stock performance. Let's bring in Barton Crockett, Senior Research Analyst at Rosenblatt Securities. It can act as a lid, Barton, but recently AI has been able to, I guess, flex above that, blow that lid off. But are we coming against the limits of how much AI can do to drive outperformance?
Look, I think that it's going to be very stock specific. We've gone through a year to date that's been beautiful in that there was a lot of fear of a recession, a lot of fear on what that would mean for ad markets, which are important for a big part of the internet coverage that I focus on. That's part of the Nasdaq. And, that hasn't materialized. The economy's been surprisingly healthy, and that's been great for these stocks. You couple that with companies that coming out of the pandemic have a newfound kind of interest in margin and cost efficiency. And then it's been explosive for these stocks. Now, I think that's been digested. And so the real question is, what's next? And AI has, recently filled the question of what's next. It's answered that. But we need to see the follow through. And look, I think that the interest rate environment clearly has been a headwind for this group on the valuation basis. But I do think that the fundamentals, where these companies are coupling secular growth with top line growth, with margin improvement, means you're going to have some really good opportunities in that space.
And when you say stock pickers, it's sort of been a situation of like rising tide lifts all boats, a low tide sinks all the boats. We saw that in 2022. Yeah. But is this the year, or do you think we're entering a period where you're going to start to see some dispersions?
I think you're seeing dispersions, So it used to be you could buy Apple and you'd be okay. And, Apple may not be the relative performer that you might see you might see a better relative performance out of someone like an Amazon from here, which is a beneficiary of AI and their web services, but also a beneficiary of a newfound focus on margin and new kind of efficiency in their operating model, but also a lot of secular growth, not only in retail, not only in web services and AI, but also in their pivot to advertising. So there's going to be, I think, winners and losers. You're going to see more of that, I think, going forward.
It's interesting you like Amazon over Apple on a day where the iPhone 15 is now available widely for sale. And most think that, as the numbers, the early indications are that they're going to maybe sell more phones than initially penned. Do you disagree with that, or do you just think it doesn't really matter?
Yeah, look, I think the jury's still out on how great the iPhone 15 will do. I think it'll do great. It's just a question of the degree of great. Apple's iPhone has to do great. I mean, that's the company. They do have an easy compare in the December quarter to the year ago disruptions in the supply chain. And so they'll have a good December quarter. They'll grow in the December quarter, which they haven't in recent quarters. But the longer term arc is of a company that has a fight in front of it to sustain growth beyond kind of easy compares, and a valuation that is near kind of peak absolute and relative levels. And not a great argument, I think, for raising estimates materially from here. I think you want to own Apple when they're moving into disruptive new areas or the valuation is truly compelling. And we might see the disruptive area evolution later on with Vision Pro, but that's going to take a while to build. And I don't think you need to be overexposed here relative to some of the other names.
Another company that's got a big fight in front of it is Disney, but this one you do want to get in front of. You're a buyer. Why?
So look, I think that Disney has iconic assets, and I don't think those iconic assets are reflected in the stock price. And I think that's because those iconic assets have been buried by a whole lot of secular concerns really tied to their positioning in the pay TV ecosystem. And I think what we're seeing this company do is position themselves to take off that dead weight, that focus on pay TV by largely exiting pay TV. They're looking for a joint venture partner in ESPN, limit their exposure there, perhaps improve the fundamentals. And they've described the other TV businesses as non-core. There's been reports of bidders circling ABC and the TV stations. They exit that stuff, and you're left with theme parks. You're left with a studio library that people think both of those things are iconic, generationally strong, and those would represent the core of a stock that I think people would want to own.
So the quibble about, especially post-Investor Day, was this kind of investing in the parks, $60 billion that they're investing. The quibble is, okay, you're already dealing with, financial issues on the streaming side that you're trying to right size, and that maybe the parks are doing so strong just because of pent-up demand from the pandemic, that's going to slow, and so you're investing into a slowdown. Yeah,
look, I think that the idea that this was a real step up relative to what we were thinking is certainly flawed. Before this day, we were assuming they'd spend $54 billion over the next 10 years, and they said 60, so pretty close to where we were. You're kind of gross spending just as revenues grow, and revenues are growing there, high single digit. These properties have had tremendous growth before the pandemic. They've had good growth coming out of the pandemic. They've had a bit of a digestion against a really, really strong comparable this year. But I think they're set up well for a consumer that's pivoting more to experiences with, I think, every reason in the world to believe that these guys can continue to put up good execution and good performance once we get past this comparable, which is really, I think, just that of an issue, not a longer term issue.
All right.